When I watch other videos on YouTube, I often find that the content is aimed at younger investors who are encouraged to put most or all of their money into equities. The premise being that you can swallow the price volatility and market falls that such assets create, as when young you have plenty of time for the markets to recover before you need to rely on that investment pot, and the risk of getting back less in the shorter term is far outweighed by the rewards that you'll get in the long run. These videos are not always so reassuring to those closer to retirement or for those who are a little bit more cautious. So if we are closer to retirement or a little bit more cautious as an individual, then what are our options for saving and investing? Well, this video is going to take a look at ways that you might feel are suitable for you in your circumstances. Whatever you choose, whether it be something you'll be covering in the video today or not, an important consideration is always to choose an account to hold your capital in, such as an ISA or a pension pot, to reduce your tax liability. Let's start from the least riskiest option of cash savings and work our way upwards to some basic investment strategies that may be of interest to you. With cash savings, everything seems a lot more straightforward and transparent. You know that you'll get your money back at a certain time, suitable to you, with interest added. Most people understand that you need to shop around to get the best rate of interest, and that best rate of interest probably won't be with your provider or even a well-known bank. You also need to remain proactive, as every so often providers offer newer accounts with better rates of interest, and a good saver will probably be moving their money around on a regular basis to chase those best interest rates. These days there are a lot of challenger banks out there, and these challenger banks are online providers with no high street visibility, which enables them to keep their costs low and to offer you better rates. Hence why these challenger banks are often the ones that offer you the best rates of interest. If you are worried about these lesser banks, you can check that your final choice or choices have FSCS protection, meaning that the first £85,000 of your money is covered should that provider fail. Cash savings also offer the opportunity to lock your money away for longer, seemingly getting higher interest rates for doing so as a reward. Although this is historically the case, in recent times, including 2024, you probably get the best rate of interest from shorter term fixes or even easy access accounts. My advice is to shop around and see what works best for you. Savings will generally not set the world alight. Given that cash savings is the least riskiest option, you will get the least reward from investing this way, as shown in the graph. This is something that you should consider, as the lesser reward could restrict you from reaching your financial goals, if those goals are in the long term anyway. With cash savings, you might be reassured that you don't see any loss in your account when you check the annual statement, and you will probably see interest added also. However, there will undoubtedly be a drag on your money's purchasing power over a longer period of time, as cash generally fails to keep pace with inflation or the cost of living. So even though you will not lose any visible monetary amount from your bank account, arguably you take a higher risk strategy if saving to meet longer term objectives, as cash savings will almost certainly lose real value. However, if saving for the shorter term, cash savings do become more competitive against assets such as equities and might be the right choice for you. When I say the word equities, I mean stocks and shares. And you can also use cash savings as that safe part in your portfolio. The next least riskiest option after cash would be money market funds. A money market fund consists of various short-dated instruments that are grouped together collectively. An example of these would be short-dated government bonds, which are called treasuries in the US, and these short-duration bonds normally mature within a month or something similar. Other examples would be the corporate equivalent of government bonds, and certificates of deposit that are similar to short-dated fixed-rate bank accounts. You can see that each instrument in a money market fund has a short duration, is of good quality and of low credit risk. UK money market funds will tend to follow the SONIA benchmark, which is the Sterling Overnight Index Average, and this reflects the average interest rate that banks pay to borrow sterling overnight. Money market funds should not be confused with savings accounts, and although low risk, there is a small chance that you may not get some or all of your money back from investing in such funds. Although offering slightly better interest rates than cash savings, they are still not necessarily much better an option, as they will also fail to keep pace with inflation and the cost of living in the longer term. But just like cash, money market funds are competitive with other assets such as equities in the shorter term, or as a safe part of that investment portfolio. Although they are low risk, there are a few of note. One of the main ones is interest rate risk. Just like cash savings, the interest rate on these accounts could fall as interest rates are lowered. This could mean that your projected returns could reduce. Another is credit risk, as the instruments in these funds are generally debt vehicles such as bonds, which governments banks and corporations issue to borrow money, there is a chance, even though the bonds issued are generally of high quality, that the issuers might default and not pay back the money owed. This is still a lot lower risk than to invest in the shares of those same companies. There is also liquidity risk where, in extreme circumstances, such as a market crash, there may be a high demand to withdraw money from the fund and a consequent delay in you getting your money due to the bottleneck caused. Mostly though, these funds provide good liquidity. There is generally no FSCS protection if you invest in these funds. Yes, FSCS protection would be afforded to you should your platform in which you hold the fund fail, but it would not be applicable to your investments just because they're performing badly. So why would you invest in these rather than cash savings then, if the interest rate is very similar to cash savings and there's slightly more risk? Well, one reason might be that you want somewhere to park your money in the shorter term whilst it's waiting to be invested. And you might treat this money market fund as a safe part of your portfolio. When the stock market is extremely volatile and investors aren't sure where to put their money, the money market fund can offer a safe haven whilst investors decide where to put their money to use. In a growth portfolio, money market funds can offer you diversity by balancing safety against the higher risks that equities bring to achieve that higher growth. If you are solely looking to save and not to invest your money, you might consider that the slightly less risky option of cash savings is better for you, especially as FSCS protection will apply to bank savings accounts. A slightly higher but still low risk option would be to invest in bonds. Interest rates on bonds tend to be slightly higher than that of cash savings accounts. Bonds tend to be less risky and less volatile than stocks, and when held to maturity can provide more consistent and stable returns. The bonds I talk about are not premium bonds, but those issued by governments or larger corporations as a means of borrowing. With a corporate bond, you do not become a shareholder in the company by purchasing one, and will potentially get lower returns than investing in that company's shares. But instead, you will get regular interest payments or coupon payments, and you will also get your money back at the maturity date of that bond. Bonds come with different durations and could mature at any time between 30 days and 30 years. Those shorter term bonds are deemed cash-like and carry lower risks similar to cash. These shorter duration bonds are often used as the risk-free benchmark to compare riskier assets against. When purchasing a newly issued bond, you will know what the maturity date is and what the fixed interest rate or coupon is. And this interest rate is normally influenced by what the national interest rate is at that time of purchase. This means that when purchasing bonds, you can calculate what your total yield will be if you hold it to maturity. And bonds generally pay coupons every 6 months. The longer the duration of the bond, the higher the risk there will be, as there is a greater chance that interest rates could fluctuate over longer periods of time. If interest rates were to rise, you would own an asset that would lose value, as newly issued bonds would come with higher coupons, making yours less desirable to purchase if you were to sell. However, if the bonds are held to maturity, bondholders don't need to worry about that and get back the entire principal. So bonds can be a good way to preserve capital when investing. And those coupon payments will continue every 6 months at the specified rate until the maturity date, providing you with reliable and predictable income, if that's what you desire. But if you purchased an already issued bond at a higher price because of its desirable interest rate at that time, then you would still only get back the principal amount at the time of redemption, the maturity date, which could be lower. Also, if you wanted to sell a bond prior to maturity, maybe because you wanted a newer one with that higher interest rate on offer, you might have to do so at a capital loss. Another thing to look for with bonds is the quality of the issuer, and bonds are graded depending on the credit quality of the government or the corporation issuing the bonds. Investors in bonds issued by companies with higher default risk or by less stable governments should get a higher coupon or interest rate as a reward for this additional risk they take. Bonds are generally a good way to invest if you want guaranteed income, as you know exactly what your regular interest payments are going to be. These are good if you want to meet a financial liability at a certain time, as you can purchase a bond with a certain duration to match this. Or they could be good for those in retirement who are just after a stable, consistent income stream, whilst getting better returns than cash or money market funds. Whether you are a cautious or more adventurous investor, I hope that you're finding the content of this video useful. If so, I really would appreciate it if you consider liking it, subscribing to my channel, and to turn on your notifications so that you know when I've posted new content. So moving from bonds to bond funds. Bond funds group lots of different types of bonds together to provide a more diverse investment. They often consist of bonds issued by governments or corporations of different companies, with various different coupon rates, and with miscellaneous duration and maturity dates. Diversity is one of the main reasons that you might want to purchase a bond fund. For instance, maybe a shorter duration bond might do better than the riskier long duration ones when interest rates rise, and vice versa when they fall. You can also get higher risk bond funds that are issued by less stable governments or companies of higher credit risk. These are called high yield or junk bonds, and these have the potential for higher returns as a reward for the higher credit risk you take. Bond funds are generally low risk overall, but maybe a little bit higher than investing in individual bonds. Bond funds are continuous, and the profits from maturing bonds within a fund then go towards purchasing new ones. With this, there is reinvestment risk. For example, newly purchased bonds may carry lower coupons than the ones that were sold, depending on the prevailing interest rates at the time of new purchases, and those lower coupons could affect the fund's performance. Bond funds also make it a bit harder to plan for a fixed financial liability or event, as they are continuous and don't mature at any specific date. Interest rates will affect the fund price, and there is a risk that you may not get some or all of your money back. It is easy to purchase bond funds as they are readily available on various investment platforms, including Vanguard for instance. And bond funds, just like bonds, can be a good way of providing income for those in retirement or for those more cautious investors who don't want that big price volatility. Moving on from bond funds, undoubtedly, if you look at historic performance over longer periods of time, the strong evidence is that investing in stocks and shares has provided far better inflation-busting returns than any of the options I've mentioned in this video so far. For cautious investors, the price volatility you get from investing in equities could cause sleepless nights. However, if you want to improve the chances of reaching the financial goals that you have set, you might not want to completely discount investing in equities altogether. And there are ways in which you can reduce that price volatility by combining different types of assets together within your portfolio. For example, you can use bonds or bond funds to accompany other investments such as stocks and shares. And the value of bonds tends to move in different directions to that of equities, meaning that as one asset class falls in value, the other should rise or not fall as sharply. This should hopefully help provide more price stability and less stress. And you can choose the proportion of your bond equity mix to suit your own needs. 60% equities and 40% bonds is generally seen as a portfolio a balanced investor might choose. But if you are more cautious, you could increase your exposure to 60 or even 80% bonds, whilst at least still keeping some equities to drive some growth and to drive those better returns. Taking this risk mitigation one step further, we spoke earlier about how bond funds provide you with greater diversity as they collectively invest in lots of different types of instrument. The same can be said of equities, and passive index funds help to reduce the risk that you would get from investing in individual companies, as you then invest in hundreds or even thousands of different companies across the index that the fund tracks. This could mean investing in thousands of companies globally. This takes away that specific risk of investing in individual companies who perform badly, where you risk losing a lot of your money by putting all your eggs in one basket. Passive index funds are low cost, low maintenance, and simple to invest in. If you add a passive index fund to a bond fund, you will have created a diverse portfolio that will help you manage risk. Granted, you might not get the same returns as being 100% invested in equities, but you should still get a reasonable return for the reasonable risk that you take. If working out asset proportions all seems a little complicated, then certain providers such as Vanguard have created ready-made blended portfolios that mix lots of bond funds together with lots of equity funds. Vanguard call theirs the Life Strategy range. This could therefore be a low-cost option for those who are less confident to choose proportions for themselves. Vanguard will even help you work out which blended fund suits your risk profile by asking you a set of questions to work out which blend of bonds and equities is appropriate for you. Remember, if you are unsure of any of this, seek the advice of a suitably qualified professional, and this video and what I tell you in it should not be construed as financial advice. Well, I hope that this quick look at less risky investment options has been useful for you. Please consider giving me a thumbs up if you like what you saw and to subscribing to my channel. Thanks once again for watching.